All through this evening, we've been talking very positive things about mutual funds. We have good reason to do that. This is a mutual fund event, and there is a lot of good things to talk about mutual funds. There is great amount of feel good, something that we've been waiting for a long time, at least me as a journalist of 25 years experience. Every time there has been a bull market, one always worried about what is coming next. And this SIP flows that all of us are talking about, this gush of domestic liquidity that is keeping markets rising and higher, comes after several years, not several years, actually 3 decades of mistrust in equities, from the Harshad Mehta scam to the Ketan Parekh scam to the global financial crisis to taper tantrum and all of that. And now, obviously, after 3-4 years of fantastic returns, one can't stop thinking about, what is to come. Is this too much of a good thing that we are seeing in the markets, and where does this lead us? That's one reason I'm super excited about this panel. Also, because some of the people on this panel they never do media appearances, you won't see them on TV. And I'm doubly grateful for you to take the time out, especially Roshi Jain. I think Roshi is coming for the first time in media, I don't know. Dinesh, all of these are reclusive people from the mutual fund industry. So even more excited to do this. So the first question I'd like to ask, maybe start with Ashish, because he put out a fantastic piece, I think about a month ago, talking about the demand-supply situation in the market, where he pointed out that since April 2022, we've seen supply of paper at about 4,80,000 crore, thereabouts. And the net flows through mutual fund industry was about 2,61,000 crore. So the supply of paper that came into the market, whether it be IPOs, QIPs, preferential offers, promoter sales, PE, all of that was about 4,86,000 crores. And the total amount of money that came through mutual funds, net flows, was about 2,61,000 crore. Despite we normally know that, if supply is greater, demand is less, then obviously prices have to go down. But during this period, the Nifty actually went up about 40%. This is in the context of a global market, that is S&P 500 during that time went up only about 22%. Now, explain to me the unsaid part in that, which is this run-up in the market, how much of it do you think is explained by the flows? How much of it is explained by growth? And how much of it do you think is just this general positivity around any bull market? And it's just word of mouth and people just latching on to something and therefore prices go up.
Sure. So thanks for inviting me, Mahalakshmi and Moneycontrol. I think, we talk about demand and supply in the market, but 99.9% of time in the market, demand is equal to supply, right? Because that is why a transaction is happening. When someone is buying, someone is selling, right? So only in the odd occasion when the market is at circuit that there is not a counterparty. So otherwise, theoretically, in the market, demand is equal to the supply. What changes is price, and the impact really comes because of differing expectations, right? I think mutual fund flows have been rising, but I think there have been previous times in the market where domestic inflows have been very strong. Retail interest in the market has been strong, either directly, not so much through mutual funds. But what really has changed in the last 3-4 years is that there has been a buildup of what we can really call systematic inflow into the market, right? And this is evidenced by SIPs. It is coming through the insurance companies. So like LIC invests about 1 lakh, 1.2 lakh crores annually in the market. Private insurance companies are now a large magnitude as well. Then we have EPFO allocating. And today, if we aggregate all of these, that itself is somewhere about $35-40 billion inflow annually that will come in the market, right? And this is giving a strong confidence underpinning to the market that there is going to be some level of consistent demand. So it is not just feast and famine, but there will be $30-40 billion of consistent demand coming in. Of course, there are multiple players in the market, so just mutual fund and insurance companies are not the only players. There are foreign institutions that are involved, domestic retail is involved, private equity is involved, and the sum total of all of those, as I said, is that net demand supply gap is zero. But what has really helped the market momentum is the confidence that a large amount of demand is now consistent demand, not really sentiment-driven demand. As you highlighted in the note I put out a few weeks ago, we have since April 23, since more than 4.5 lakh crores of supply by promoters, private equity, IPOs coming into the market. And that has really outpaced what was the inflow from the mutual fund. So the mutual fund inflow over this 15-month period was roughly 3 lakh crores, the net inflow. But really still the market went up because in addition to the mutual fund inflows, over the 15-month period, FIIs also have been a net buyer. Direct retail has also been a strong net buyer of nearly 2.5-3 lakh crores. So that has meant that there has been a very strong impetus in the market. And what I wanted to highlight is that, yes, while the narrative is strong, that consistent inflow is high, there is a consistent supply also at this level. And the market direction going forward will be determined by the more volatile pieces of demand, which is FII demand, which goes through its cycles, as well as domestic retail. So domestic retail interest is very strong today, but it varies.
Sure. What's your take, Dinesh? I think the one part I'd probably like you to expand on is the fact that, according to Ashish's calculation, more than 5 lakh crore of supply can come into the market over the next 3 to 5 years. Isn't that true? So in which case, where do you see the market? Is that commensurate with the kind of demand that that could be created through domestic flows? Or are we going to be in a situation of oversupply?
In general, I've always felt that supply demand is a second order effect. It has an impact on valuations, it has an impact on markets, but the primary impact is always earnings, it's always growth, essentially, right? So supply demand, it matters, but it's a second order effect. So when you think about where markets are going to be, the question to really ask is what is going to happen from an economic GDP growth perspective, because that is the number one driver. When you think about why markets have done well over the last 3-4 years, right? You also have to ask yourself where all these cyclical sectors were 3-4 years ago. A lot of them were essentially had just gone through a decade-long underperformance, where a lot of the weaker players exited that space. So the remaining guys were the survivors, and they slowly started having pricing power. So even with a very modest increase in order activity, you could essentially see the margins improve substantially for these players. And so it's no wonder that a lot of the cyclical companies have done extremely well over the last 3-4 years. The challenge right now is, yes, supply, or demand rather, has been extremely strong, be it from retail investors, either through direct stock trading or through investments in mutual funds and insurance policies and so on. So that's definitely played a role. But if I have to think about where markets are likely to be over the next 3-4 years, I keep wondering what is really going to happen from a GDP growth perspective. And if we believe that a lot of these cyclical sectors have only now gotten off the mat, so to speak. Yes, margins have improved, but the order book is not in such a tremendous shape where you can say that, oh, they've had like several good years of, high double-digit order growth and stuff like that. We haven't seen that. And from that perspective, unless and until there is a serious accident, I would like to believe that that should continue. And if that is the case, even if you have a derating in terms of valuations, because valuation multiples are very high, no doubt about that, but the outcome is not going to be as bad. But this situation changes if you believe that there is going to be policy paralysis, the GDP growth rate, which a lot of people are believing that it can probably finally accelerate above the narrow band that it's been in. If that doesn't happen, then guess what? All the supply demand, it doesn't really matter. Markets are going to struggle, essentially.
Sure. What do you worry about, Roshi? I mean, last 3-4 years, like he said, I think a big part of the trade was that we were in the dumps in terms of, where we were in the economic cycle. And as the economic cycle, I think before COVID, we were already in a slowdown in 2019 or so. And of course, the last decade was nothing to write home about. Right now, over the last 4 years, that trade has already played out. A lot of what Dinesh is perhaps talking about, operating leverage and all of that. Now, where are we? Can we sort of course, it'll be too obvious an answer to ask a question saying, can we replicate the performance? But does it get you worried?
Clearly, I mean, valuations is one part of the story, which is that, yes, there are pockets of overvaluation and significant overvaluation. But I do think that if we don't look at it from just a 1 year or a 2 year perspective, and if we take a slightly longer term perspective, corporate earnings are still perhaps going to grow, somewhere in the low to mid teens. And there will be segments and sectors which will offer the compounding opportunity. So while, valuations at this point from a 1-2 year perspective are stretched, I think over a 5-year plus time frame, there are still segments and sectors which will continue to give us that compounding growth opportunity. I think what I worry about genuinely is that this general euphoria has taken away some discipline in terms of the way we look at stocks and valuations. We've perhaps started to paint almost all companies in most sectors with the same brush. I think the kind of analytical rigor in terms of separating the good companies from the bad has perhaps been diluted a bit, and that's because we've had this very strong euphoria in the last 2, 3, 4 years, where perhaps weak performance hasn't been punished as much as it would have in the absence of this huge liquidity. So what I worry about is just this sort of dilution of discipline and rigor, which generally happens when you go through this very euphoric liquidity and good times in the markets. And not to say that we will not have companies which will give us compounding returns in the next 5, 7, 10 years. It's just that we need to be sure of the companies that we are backing at this point in time.
Sure. Good you picked on that point, because I just listed a number just before coming here, a comparison of PE distribution. I mean, I know everybody doesn't subscribe to PE as a metric. It's very rough cut. But nevertheless, in 2008, more than 68% of the companies had less than 20 times earnings. Right now, that number is less than 28. So, in a sense, there is a sort of a reversal that majority of the market is really sitting on a higher plane. So, Rajeev, how is the playing ground today compared to the peaks that you have seen in the past? Does it put us at greater risk of, diminishing returns over the next few years?
I would think yes, Mahalakshmi. So, various kinds of supply comes into the market, and typically if companies are issuing fresh equity for capital expansion, capital expenditure and capacity expansion, that's a good sign, right? Economy is growing. The worrying sign that I see in the past year or so is strategic investors or promoters are selling stakes in their companies because they don't find it worthwhile. So whether it be MNCs or whether it be Indian family promoters, they are selling stock because they don't find the stock attractive enough. And arguably, they are the people who know the business the best. So it is said in jest that at the beginning of the bull market, the promoter has the vision and the retail investors have the money. And towards the end, the promoters have the money and the retail investors have the vision for the business. I think that is the worrying part. A lot of offer for sales are happening. A lot of secondary market sales are happening. 20 P, let's say if P is stretched, maybe we are factoring in 1 or 2 years of extra earnings. That is fine. But in a lot of pockets, you have numbers like 70, 80, 100. You have loss-making companies. You have multiple narratives. So you have high valuations on quick commerce and you have a high valuation on big box retailers as well. Now, arguably, one will eat into the other. Everything cannot do well all the time. So you have EVs doing well and you have traditional autos also doing well. So somewhere something has to give. And the other worrying factor for me is maybe markets are discounting 2 years earnings ahead or something like that. That would be okay, more or less. The fact today is an entire generation of new investors have not seen a sideways market or a bear market. And they have just come looking at the rear view mirror, trailing returns. What happens when there's a 6 month of a tough period is untested.
Sure. From a product perspective, Sanjay, how do you see this market? Because traditionally, I think Kezad also quoted a lot of numbers in the first session that we are at record in terms of, NFO collections. For the first 8 months of this year, we've already surpassed total collections of last year. And we have, this is also driven by thematic funds. And we've known, every time there is a market peak, all these products come in and then they are backbenchers. So is that a contrarian sign being a product designer? What's your take?
So that's a very interesting...
Because you guys are the manufacturers of this whole thing.
So first of all, I think there's a lot of time spent on the NFOs and the thematic funds. The way I would look at it as a manufacturer, if there's a white space and the regulators define what are the spaces that each fund house can actually have. So if there are white spaces, they would launch it. For example, 2.5 years back, we did not have a flexi cap fund. And I think there are some fund houses who still have a white space in some of the key categories. And that's where the product launches are actually happening. They need to build up the track record, and once it's there, then they'll be able to sell it out there. Clearly, what we've seen is a trend where the manufacturers don't really have too much of space in terms of new products. And there are certain themes which are emerging. It's not that the manufacturers are just producing to gather assets, but clearly there are some new ideas, new themes emerging. For example, the new energy theme which is coming through. It's actually throwing up a significant opportunity. Would I take a significant portion of my portfolio in the new energy theme, despite the fact that I believe it is the right theme? I think those are the opportunities that the investors are trying to encash out there. And that's something which can throw up interesting investment opportunity for the investors. The question that we should be asking ourselves, are these themes enduring? Are they long-term or are they cyclical? Because we've seen that happening in 2008. Kalpen mentioned about the infra theme. It went through a cycle, a down cycle, and they had to relaunch the whole thing. So for example, as a fund house, instead of launching an IT fund, which may be cyclical, we decided to launch an innovation fund. Okay, so it captures not only the IT sector, but the entire gamut. And I think innovation as a theme is going to sustain and be more durable than a maybe a sector fund, etc.
Sure. Dinesh, let me pose this question to you. You are the largest, you represent the largest mutual fund in the country, and everyone is launching new funds. How much buy-in do you guys have as fund managers in what funds are launched, what themes are launched?
Oh, there is significant buy-in. Actually, when you think about the internal discussions that happen, now obviously, when you think about it, right, there can be a perceived conflict of interest where if you are wearing a sales marketing hat, you are always going to think about essentially getting that next rupee or next dollar in. And from that perspective, NFO always represents a good opportunity. As someone was mentioning in the previous panel, NFOs do bring in new people into the industry. So if you are just wearing a sales and marketing hat, you are going to sort of pitch that, right? From an investment professional perspective, you are worried about the ramifications of these NFOs in the sense that you are the one responsible for what happens post-launch. So if you are not convinced on the theme, it's going to be a big challenge. So when we have these internal discussions in terms of, okay, which NFO, if at all, we want to launch, there is an extensive discussion in terms of what we are okay with and what we are not okay with. Stuff that we are not okay with, we just put our foot down and say that...
Have there been instances like that where the product team wanted you to launch a few funds?
Multiple.
And you said no?
Unfortunately,
you're not ready to manage this?
Too many to count, to be honest, because I don't even want to talk about specific themes because other funders have launched, and it's their call, right?
We'll go to
but
for that.
No, but there are themes that we, frankly speaking, don't believe in. So we've said no to that. And so then it's really a question of which themes do we believe has staying power. And that's basically, those are the themes that we've decided to sort of bring to the market. And they're also sort of represented in our other funds in terms of, if you really believe in a theme, it has to be seen in our funds, right? So from that perspective, there is clearly a harmony there that we believe in the other funds. That's what we are bringing to the market as well.
Sure. Ashish, you think we are setting investors for disappointment with thematic funds?
So I think Sanjay touched upon a very important part, that the theme has to be long-lasting, right? It does not, cannot be very cyclical, right? And he gave the example of infra. Frankly, if you see 2000 or even 2020, 21, IT funds got sold the maximum there, right? And the challenge is some of these things become flavor of the day and therefore get attracted. So I think the way we have thought, and like Dinesh, we have big tussle with our product and marketing team because they want to do what sells most easily in the market. But really, the other lens we see, besides the long-term structural theme, is that the theme should be broad-based enough for us to actively manage it, right? Because I think all houses or most of the houses have passive products as well. And if we are launching a theme, it has to be broad-based enough. It has to provide opportunities to invest in multiple set of companies, multiple types of businesses who do not have congruent business cycles. Because then really the fund manager can only deliver you beta. He cannot deliver you alpha. So if we have to deliver alpha, so for example, we last year did one thematic fund manufacturing. We are doing another one consumption actually from next week. The whole idea is that manufacturing is not just now about autos, right? It is, so in our manufacturing fund, there's auto, industrials, pharma, etc., right? And all these cycles don't simultaneously go up or down. Similarly, in consumption, there's FMCG, there's retailing, there's quick commerce. In fact, we even have stuff like real estate, etc. So there are multiple cycles within the broad theme you can play. There are diverse set of companies you can invest in to try to give an investor more consistent experience. Otherwise, I think if it's a narrow theme, we would rather just launch an index fund.
True, but looking at the NFOs that have been launched and the themes that have been launched by the industry, is that truly the case?
So each to their own.
I see that a number of people coming onto our channel are outright rejecting defense. pocket of stocks. But we've had like some of the highest collections of sectoral funds
I
in
will
defense.
actually say that my belief is we are manufacturer. So in the sense, if an investor wants to buy, then in these themes have an index fund, right? So because then the investor wants to buy the beta, his advisor wants to buy that theme for 2 years. He believes that he can take the call for 2 years or whatever time that theme will work and exit. So I would prefer to have a passive fund in that category. Because today the competition is not just among AMCs, it's between active and passive fund managers as well. And I think active funds have to give more consistent returns.
Does passive really solve the problem, Roshi? If you're bearish on the sector, you're bearish on the sector. I mean, it wouldn't have helped to have a passive fund in technology in 2000.
You're asking an active investor, and clearly, you know what the answer will be. But there's one thing that I think we need to realize, which is that this is a natural process of market evolution, and this is not just happening in India. As markets mature, as profile of investors increases, the number of investors, the reason why they are investing, you will have to come up with solutions for them. You can think about any industry for that matter. When the automobile industry started in India, how many car models did we have? You could count them on your fingertips. But as the market grows, as newer customers come into the industry, there will be a significant scale, even in a small niche, and then somebody will start addressing it. Today, how many car models? I mean, and we are still perhaps nowhere compared to, some of the more developed markets. My point is this, that as the Indian economy has grown, it has, and as the markets have evolved and matured, it has created significant scale in even niches, which is what I think mutual fund houses are trying to address. Now, we've talked about, and there are different themes and so on, so forth. All I'm trying to say is, as the mutual fund industry also grows, it is trying to address these niches. And that's what I think we are solving for. These need not be your generic products. These may be suited to a few investors, and that's why you have advisors and distributors who will see whether that product is suited for their investor, and then accordingly position that product. So I think when we talk about thematic funds and all of that, this does not have to be a mass product. This could be for your niche investors who perhaps need or understand the risks and want to take that slightly higher bet, which you cannot do in a mass product. There may be many themes which are very underrepresented in a mass flexi-cap type product, and an investor perhaps wants that little bit more risk. You just do it via this niche that is offered. So that's my very broad take on thematic funds and so on. Yes, some of it will be cyclical, but so be it. I mean, if you're a sophisticated investor, you clearly understand cyclicality. So then you know what you're getting into. So I would just say that as markets evolve, we should be prepared to have more customized products come in as well.
Sure.
Can I just chip in? Yeah. Ashish brought out an interesting point, and Roshi also spoke about the same thing. I think there's a need for products to be in the market, whether it's an active or passive. In an active fund, the sectors are chosen by the active fund manager. In a passive fund, the decision making for choosing that sector, whether you're bullish or etc., actually shifts either to the distributor, to the distributor or the customer. And I think that can play a very important role in terms of active versus passive.
Fair enough. Rajeev, you made this point on valuations being higher. Today, are you, and even Roshi made this point, so are you ending up buying stocks that at prices that you would not have bought earlier?
So we have never subscribed to the theory that we need to be fully invested at all times. We have not shied away from being invested in money market instruments, and today cash is at above average levels with us. If we don't find something attractive enough, just because we have an inflow, we don't force ourselves to buy.
Sure. How about you, Roshi? Are you ending up buying stocks higher?
The answer is going to be a bit nuanced. We are running at slightly higher cash levels than we normally would, so that is true. But please remember that even with those slightly higher cash levels, we are still 90% invested. So while 10 may appear on the higher side, there's 90 instead of 95, which is still invested, which tells you that clearly there is an opportunity that we still see for equities. The only nuance that I would say is that the time horizon at this point in time genuinely has to be long term. And while we said that even last year, I reiterated this, you didn't have to be long term last year. I think the 1 year has paid off really well. But
What is long term?
I would still think that today, if the horizon is, let's say in the ballpark of 5 years, you will still make your risk-adjusted spread.
Are you buying stocks higher than you bought earlier? Have
Yeah.
you pushed up your valuation threshold?
I have to say, again, when you think about this, this cash level. So I manage the contra fund. And I used to think that having high cash is a nice contrarian bet. But actually, in fact, recently someone published this, the level of cash is high across the industry, which means that everybody is sort of inherently not very comfortable with valuations. Now the problem...
No, but I think as a percentage of total AUM, it's not radically different. It's probably 1% or something. It's because of the NFO collections.
No, actually, like for example, in contra fund, right now the cash level is like around 13%.
In your fund?
In my fund. So from that perspective, you can say that I've been sort of not so comfortable with valuations. But then there is also this catch, right? 3 years ago, I could put a 20% IRR threshold and find a lot of opportunities. 2 years ago, I could put a high teens, now whether you want to call it 16, 17, whatever, some reasonable range, and look for opportunities, and I got a lot of opportunities. Right now, if I put a higher than 15% IRR, it's extremely difficult to get. But the question sometimes I ask myself is, if the alternatives are all at single digit, should I really be at 16, 17%? Or am I okay even with a slightly lower? No, obviously this is a slippery slope, because once you start sort of going down the slope a bit too much, you end up taking too much risk. But what I've seen is that let's assume a lot of people think cost of equity is around 13%. Right? If you think 13% as the rough sort of hurdle, are there opportunities right now in the market? I think the answer is yes. But are these opportunities the same as what we saw 3 years ago or even 2 years ago? The answer is no. So from that perspective, I feel inherently uncomfortable that I had all these opportunities, they're not there now. But 13% in the grand scheme of things, it's not so bad either, right? So it's like one where I'm obviously moving up the valuation ladder, but am I sort of stretching it so much that I'm talking about now having to justify with a single-digit discount rate and stuff like that? The answer is no.
Ashish, do you think, there is also the other risk? Because if you just go back 1 or 2 years, and I asked this to a lot of fund managers, and they say, hey, we were sort of somewhat bearish 2 years ago also, and if we had decided to sort of go down to, 20, 30, 40% in cash, then we would have underperformed even more. So are we prisoners of the past in terms of thinking about valuations? Because is it possible that this whole liquidity, and right now we are also in an environment where everybody is talking about interest rate cut in the US. If that happens, something that has been in the negative for some time, not negative, but marginally positive in terms of FII flows, that starts to gush in. Is the risk the other side, that valuations could stay elevated for longer time, maybe even higher? So you should be more bullish.
So frankly, as a fund manager, as an investor, I will always want the stocks to be cheaper than where they are today, and want to buy them cheaper when compared to what they are. I think about cash levels a bit differently. I think, and also Roshi mentioned that increasing the cash level can give you only very slight hedge, right? So maybe you can be instead of 90%. So that does not really materially change your return matrix, etc. Right? So, and the other conceptual challenge I have with cash levels is that are we repeating something 3 times? So, cash or being invested in the market is really an asset allocation decision. The investor is doing that. Then his advisor is doing that. And then should I do that again, right? And I think I therefore, and again, all of us are benchmarked investors, so I kind of look at really more in terms of beta, right? So what is the beta of my portfolio? Should it be more aggressive or should it be more moderate? And really asset allocation, we focus more on the hybrid funds. And there certainly today, the equity allocation is in some funds 15-20% lower what it was a couple of quarters ago, right? But on the equity funds, we generally don't want to play too much with the cash levels because I think the asset allocation decision is being made by someone else. Depending on the comfort with valuations, earnings, sectoral mix, etc., we would kind of tinker around with the beta of the portfolio more.
Enough. I want to pick on a point that Rajeev talked about, that, promoter selling as an important sign of market speaking out. And this is actually not new. It's been happening for more than a year, perhaps even more now. Dinesh, tell me, how do you look at this? One side of the story is everybody tells me that, unless more equity comes in from promoters, how are we going to get the papers? That's not good enough. So tell me something better.
No, I think first of all, this promoter selling, again, you have to put it into different buckets. There are obviously promoters inherently as a group. They are the most knowledgeable about their companies. So whenever they buy or sell, there is a huge signaling effect, right? And you have to obviously pay heed to that. But then there are these promoters who, for example, when we think about like some of these MNC companies selling, there are these opportunistic MNCs that have just seen the valuations of their subsidiaries skyrocket, and they are looking at the valuation disparity between where they are trading in overseas markets and where the Indian subsidiary is trading, and they want to take advantage of that. And you sort of worry about being sort of like, left with the bag at the end kind of thing, right? But then there are also cases where the parent is in financial trouble, where the parent essentially has a very high debt burden to take care of. So there, they are essentially selling because this is the only thing left that is liquid, and that is something that they can easily sell. There, we want to take advantage of that. So from that perspective, not all promoter blocks can be put in the same category. In general, you have to be careful because they clearly know a lot more about their business than almost any outsider does, right? But when we think about these sort of so-called financially precarious sort of promoters or promoters where they just need to take care of the debt burden, we'll be very happy taking on some of those blocks essentially.
But a bunch of it is just selling not only because of debt or MNCs. How do you look at it, Roshi? And I'm also told that in good companies, so-called good businesses and managements, there are fund managers who are actually going to promoters and saying, give us a chunk, we want to buy in. That is also happening. So how do you look at all this?
So I think sometimes perhaps genuinely the promoters also want to diversify, which is not a bad thing maybe, because, there's personal equity, capital involved, etc. And you've seen this massive re-rating, and you do want to sort of do what any perhaps prudent investor does, which is that take some money off the table, perhaps put it back in equity markets. And I'm sure there are a lot of distributors here who are helping their promoters do the same. So some of it is perhaps just what any prudent investor would do. I would only say this. In every market, the buyer, it is buyer beware. So you don't have to buy what the other person is offering if you don't like it, and if you feel that valuations are stretched or you don't have visibility of the business. So as long as, and therefore you have mutual funds and fund managers do that job for you. So I think as long as we are just doing our due diligence well, nobody is forcing anything down your throat. I think we'll just make the right decisions for ourselves.
Rajeev, since you started this point, you can have the last word. What do you think? So, especially this comment that Roshi is making is very true, that promoters taking money off the table and plowing it back into equity markets. That looks even more ridiculous. That I don't believe in my business, but I believe in all other businesses listed, or whichever business I choose to invest in.
Yeah, so fair point on diversification. So sometimes there's a generational shift. One sibling may not want to be in the business and pursue some other interest. So those kind of needs obviously are there. In some cases, we have seen like private equity funds completely exit. Now, a lot of companies are fully 100% owned by minority or the public shareholders. So in some cases, there have been large strategic sales. So there is some nuance here. You have to go company by company. Yeah, but the point that in some cases, promoters have felt that it's no longer worthwhile running the company at this valuation, and I would rather create a family office out of the assets. Only part of the money comes back to public markets. A lot of it goes into, let's say, commercial real estate or these warehouses or some private investments and things like that. So some people have said it's worthwhile exiting at this price.
Sure, we are running out of time, but I want to ask, some quick questions, Roshi. At this point in time, I think you manage some of the largest funds. Do you wish you were in a smaller fund, managing a smaller fund?
There are pros and cons of both, and it's a discussion that there is no right answer to. The only thing I'd say is this, that a larger fund forces you to be more disciplined. Because the size of positions is such that you just need to be sure of what you're doing, which actually is not such a bad thing, because that discipline pays off in the long term. While in the short term, you may think that size is a barrier and so on and so forth, but the discipline that it inculcates in the fund manager's psyche, I think that genuinely helps in long-term performance. But like I said, there is no conclusive answer to this debate.
What about you, Dinesh?
Oh, I will take a smaller fund any day.
Sorry?
Smaller fund any day. Because when you think about it, right, like
Today or any day?
Any day, actually. Because when you think about it, there are a lot of ideas that are not scalable. These are very good alpha ideas, but they're not scalable. So if I have a large fund, then I won't be able to take part in that. On the other hand, if I have a small fund, I can take part in that. So it really boils down to sort of letting go of a subset of investment ideas that you can otherwise avail of. But the point is well taken, but that often what happens is what you think of as a natural advantage can also come in your way, because if, let's assume, you just throw caution to the wind and you try to do everything because you have a small fund to manage, there can be a rationale that comes with it, which can be a problem. So as long as you take care of that aspect and you have the same discipline regardless of whether you are managing a small fund or a large fund, obviously I will take a small fund any day.
Sure. Sanjay, you wish you had a different job, a sales job right now, because a lot of sales bonuses, or are you happy with being in product design?
So I've always been an investment professional for the past 34 years. I love the job. 34 years is my professional thing. Actually, I've been in the market right from my 10th standard. I just love it.
Ashish, you wish you were in sell side now?
So I actually have best of both worlds. I still write, so I think I can have the best of both worlds in this job.
Thank you so much. That's all we have time for. Thanks for being such a patient audience.